It's Matthew Lucas speaking. I appreciate your time today. We're just on slide 2, just talking about Spheria at the moment. We now have nearly 400 million under management. We saw good support from institutional clients at Schroders who came across 2 of those clients, and obviously we've had good support from the retail market. The funds have performed well. It has been a difficult market to generate alpha if you look at our peer set, and you can see that we've generated good returns in both funds over 1 year and since inception. We actually think there's good opportunity in the market, and we're going through an iteration process now after result season and trying to find good ideas, and we'll talk about that further in the presentation. What we're finding is we're actually getting good access to companies. So we've had a lot of good meetings. We're still in that meeting process period. So we've seen a lot of companies in the past month or so, and that will continue over the next week or two as you stretch that result period into mid-September these days. For example, AWE, we saw the chairman 2 days ago and 2 of the board members, and today we had a one-on-one with the management team. So we're getting good access to companies. Moving on to slide 3, what you've seen since our last webinar, and we talked about this at the time, that microcaps were under a lot of pressure going into March, April. We've seen a rebound in that microcap space. You can see the emerging companies index has actually rallied very strongly. We've benefited from that. The small companies fund has been positioned down the spectrum into microcaps, so it's seen a benefit from that, and you can see that in the performance numbers. The actual small cap space hasn't rallied as much, and that we think provides quite an opportunity. If you look at the large cap space, it is very expensive. We look at the mid cap companies, we look at the large cap companies, and they look very expensive to us. So we think there's still some good opportunities in that microcap and small company space. We move on to slide 3. I'll pass on to slide 4. I'll pass on to Marcus to discuss that.
Thanks, Matt. So Marcus Burns here, the other portfolio manager on the Spheria funds. So we're also here to talk about some winners and losers over the reporting period. Obviously, it was a fairly volatile period as the market saw numbers coming through, or in some cases failing to come through, and we saw some very large reactions to share prices, both positive and negative. And we always find that this period gives us typically a good chance to go through, especially when stocks materially underperform. If there's only a small downgrade in stocks, get sold off aggressively with a big change in sentiment. We often find during this process we can pick up some great stocks that have good balance sheets and good cash flows and might be missed to see by the marketplace. So some of the winners over the last month are in this chart here on page 4, and you can see there's some very large moves in things like Star Pharma and Highfield Resources. And also Blackmores had a very good period. The stocks in dark green, they're the ones that we actually have in portfolio. Typically, stocks like Star Pharma and Highfield, although they had a great period of performance, in both cases those stocks don't generate cash flows, and so they're not in our portfolios. We do require cash flows as a core ingredient to how we think and invest, and we find that over the long run, stocks that don't generate cash flows whilst they have these periods of strong performance periodically. Over the long run, if you don't generate good cash flows to support valuations, they tend to come under pressure. Go back and look at previous presentations. We had another stock last time that also had very good performance, had no cash flows in the biotech space, but subsequently in a very, very poor period of performance over the last 3 or 4 months. And stocks like Class Limited, which has been a core holding in microcap and small cap funds for a long period of time, had very strong results, backed up by good cash flows and a very good balance sheet. And that stock, we believe, will continue to perform very well in the medium term as it takes share in the SMSS space. And then finally, Vita Group, rounding out the top 3 there that we own, had reasonable sort of figures, but more importantly, gave clarity around the Telstra contract. And I think the market rewarded the stock a bit because it actually realised that long-term margins were sustainable around the 3-4% level, and the stock sort of bounced out of those results.
Thank you, Marcus. Just moving on to slide 5, and just looking at the losers over the month. And I'll say this: we will make mistakes. The average fund manager probably gets just over 1 in 2 right. We hope to get more than that right. We hope to be better than mediocre, but we will make mistakes. If you look at that chart, you can see that there were some pretty dramatic falls in the Small Ordinaries Index over the month, and usually that related to either a profit warning or a poor result. Clearly, CSG, which is a printing-related company, is one that we wouldn't invest in. It doesn't generate any cash flow. Basically, it plows it all into rolling out more printers to its customer base, and then trying to support those customers and selling products on the back end of that. It's a business we don't particularly like. GBST, on the other hand, is a business that we've looked at in the past and we've shied away from. It does generate good cash flow. It has a good balance sheet. It seems to have some good core competencies in the software it produces, but it is facing a lot of challenges in that UK market. So it's one that we've got a watching brief on because it does tick a lot of our boxes, but it did face some significant issues during that period. One company that we did own that came out with a profit warning was Isentia Group, and it is a company that we think has strong fundamentals. It has faced some significant headwinds in the short term, particularly from one of their competitors. It appears that competitor has been stealing information from Isentia, and that's going through the court system at the moment. A favourable ruling on that front, and we believe that it's moving favourably, would mean a significant uplift potentially in Isentia's earnings. So we're still positive on the company. Isentia dominates the space it's in. It has the best product, but it is facing some competition. But that competition is on pretty shaky foundations.
And actually, the competition has admitted to having an account and siphoning information off through their own accounts to their own client base. So we think there's good grounds that Accenture has there for that reason.
Yep, it is a company that produces good cash flow. Cash flow has good market share and has a strong balance sheet. So we think the outlook will improve for that company. But there are a few companies in there. You can see that there's a few roll-ups in there which are souring, and invariably roll-ups do sour. So we are cautious on buying into companies that roll up assets. Generally the underlying trends are not that positive, and they buy assets to cover up those underlying trends. So a Hansen, an Automotive Holdings, those are the companies that fit that bill that have made a lot of acquisitions and we think could come unstuck. Just moving on to the next slide, it's slide 6. Just looking at a company, we owned Blackmores at our former employer. We owned it for a long time, I think from around $18 upwards, and we sold down that position into strength over the years. We did have a small position in the funds at Spheria. We've owned that for a while. We have been a bit cautious on the outlook for the company. They have faced a number of headwinds in the core business. However, we think a lot of the issues have been execution related. If you look back through the history of the company, it has been a very strong cash flow producer, so it ticks that box for us. Obviously, it has a very strong brand and a very strong market position in this country. The biggest issue we have with the company is it is under-earning. It's generating margins of around 12%. A lot of its peers generate much higher returns, and some of those peers are inferior. We think, BWX is an example of a company that owns the Sukin skincare range. It produces EBIT margins of 35%. It has the same distribution channels as Blackmores. It has less scale. It only sells $72 million of products a year versus a Blackmores, which is selling $700 million in products a year. We are surprised that hasn't been action in the past to improve the performance of Blackmores. We think the new CEO hopefully moves it down that path and we see a better outcome for Blackmores down the track. This can't go on forever. The company at some point will have to generate better returns. Otherwise, there will be actions taken by shareholders and the board. Even Goodman Fielder generated margins of 13% as a listed entity. I mean, Goodman Fielder sold some pretty inferior products through the supermarket chains. We see Blackmores as a much superior product in that market. So we've got a very optimistic view on Blackmores. We think they can turn it around. We think sales to China will continue to grow, and you will see some operating leverage out of the business. And we believe it is significantly under-earning at the moment.
Thanks, Matt. And on page 7, we just talk about Beacon Lighting, which is another retailer we've spoken about before, I believe, and one we've had again in the funds for some time. And also, a bit like Blackmores, we bought the stock in the IPO probably about 2 years ago. And we think we do look at businesses that we think are competitively advantaged, and stocks like Beacon Lighting, in our view, do tick that criteria. You can see on the left-hand side there our classic free cash flow chart we generate for all our investments, all models we do. And again, free cash flow Beacon has been historically around the 74-75% level, which is solid. The balance sheet's not very geared, and on the right-hand side of that chart, you can see this is a chart from their prospectus they put out a couple of years ago, but it still holds true today. That the 61% share there demonstrates how much of the advertising spend in the category that Beacon Lighting has. So Beacon has roughly a 20% share of the lighting category by sales, but spends almost 2/3 of the entire advertising category by marketing spends. Now, we think that gives them a real advantage over their peers. They've got massive share of voice in that space. They kind of really own that space in terms of the consumer's mind. The stock got sold off pretty heavily in the first half of the year on fears that, one, property downturn was going to affect all these stocks. Two, weak consumer, and three, obviously Amazon, the great Amazon is going to come to Australia and wipe out all retailers. Now, we understand Amazon's a fantastic business. We believe in Amazon, but we also think that the stronger retailers domestically will adapt and survive. And Beacon, who do their own sourcing, we think will be a very strong business for many years to come. In fact, could actually use Amazon as another form of distribution. In some cases, people doing their own brands and supply chains end up selling their own product or a product made for Amazon through the Amazon marketplaces. So it's possible that the two will actually coexist symbiotically. And Beacon really forms one of the two or three names we bought in retail, Matt, over the last quarter or so that have rebounded pretty strongly. So names like Adairs, we also own the funds, that also traded well through this results period. People sold it off again on the fear that Amazon would clobber them and had a weak trading period back half of last year. But we saw a business that was, pretty solid. Again, controlled by destiny because they controlled sourcing from Asia right through to the shops without paying any independent brands. And it's had pretty good results back of trading pretty well in the second half of the year, and it's bounced quite nicely. So we try and go through, look at cash flows, look at valuations, and try and look through the noise and find opportunities. I think that's why Matt flagged earlier that we're seeing opportunities now in the marketplace that many people think is pretty fully priced. It is pretty fully priced, but within that, there's been quite a lot of movement at the share level, and we're seeing that generating some good ideas in micro caps and small caps for us.
Adairs is an interesting example because it listed 2 years ago with much fanfare at $2.50, came out of private equity. It might have been $2.20, but its margins at the time were 15%, so it was generating EBIT margins of 15%. 2 years prior to that, it was generating margins, I think, around 10 or 12%. It might have been even lower. And so they really picked, they picked the time to list it. It was right at the peak cycle in terms of sales and margins. What you saw post that is business came off, so sales slowed, margins came down, and they got to a point where the market was factoring margins of probably mid-single digit in the share price.
Yep.
So we bought a big stake in that company. It is a well-positioned franchise in that space. It is taking market share from its competitors. They've got a very loyal customer base, and it generates good cash flows. So we've seen that bounce considerably since we bought it. And obviously now the market is factoring in higher margins, but we think those margins will go higher than where the market anticipates.
And that's one of the reasons that many, including us, are very sceptical about IPOs, particularly from private equity groups, where they're very clever at picking a good time to sell a business. And typically they're picking top of the cycle, either with earnings growth or multiples or margins or all three. And so maybe they're good companies, they're IPOing often at the wrong prices. So the outlook, turning to page 8, is that as we've kind of flagged during the presentation, we've seen quite a bit of volatility over the last month with reporting season, and we think that in many cases that's kicked up a couple of interesting ideas that we're chasing down now post results as we meet companies and doing more models. And there's a couple of names there that are coming through that we think are attractive and will build into portfolios. Long-term companies that are speculative in nature. And by that, we mean stocks that don't have fundamentals to back up the movements in the share prices. We think that over the long term, interesting stories or high growth rates with that cash flow to back them up will ultimately come under pressure and not prove to be good investments for clients and investors. We are consistently wary of roll-ups because the roll-up stories usually end and or they pay high prices, or they're relying on constant M&A, which is fraught with risk in our opinion. And invariably they do come under pressure, so we're cautious on those kind of stocks. And then lastly, we've flagged retail sectors being a sector we've bought back into in the last few months and made reasonable returns on. We still see some valuation support to the retail space. But commodity prices have started to improve. Not just gold, but iron ore has been pretty strong. Copper, even nickel, of all commodities, has finally had a bounce. And we think that there's some interesting opportunities in some of the resource stocks. We are careful about which ones we buy, or resource-related industries. So in some cases, the second derivative resources, being the mining service companies, can be occasionally very good, interesting opportunities for us to buy into.